lending with Marshall Reddick Real Estate. And as I mentioned, my name is Patrick Prunty. I'm the VP of Lending here at Marshall Reddick Real Estate, and I'm just so excited to be here with you guys. I mean, it's such a pleasure to be on the phone with like-minded real estate investors and those looking to get started. We have a ton of people on the call tonight, so I probably won't be able to get to too many questions running the webinar solo tonight. And like I said, a bunch of jam-packed information. Hopefully we can get through most of it in about 45 minutes. So let's jump in right away with a poll. Okay, and you can see that on the screen, but I'm going to actually launch it and get some feedback and publish the results. So have you ever done any private lending before? Okay, so you guys should have that on the screen now. And we're going to let this go for maybe, I don't know, 10 more seconds. Okay, getting a good turnout. Okay, just a couple more seconds. Okay, so we're going to close the poll. And I'll share the results. You guys should see then 26% have done some type of private lending before and 74% no. That's with 88% of the crowd voting. So a lot of newbies tonight. I love that. You're definitely going to learn something new. I guarantee it. So let me hide that and we'll continue on. Thanks for participating. So we offer two programs, and you should know that up front. Okay? Program 1, Mailbox Money, that's what we're talking about specifically tonight. And specifically, we're talking about funding buy and hold loans, residential property, and buy and hold loans. Okay, so buy and hold's underscore or underline, you're going to remember that later. Program 2, I call it the QFCR program. Okay, and that stands for Quick Fund, Collect, Repeat. And in this program, we're talking about funding fix and flip loans or fix and refi loans. It's very popular these days. You know, if you guys have heard of the BRRR, you know, a lot of people are coining that term, especially on places like Bigger Pockets where it's buy, renovate, rent, and refi. A lot of that's the fix and refi type thing. But nonetheless, we have two programs, and I'm going to compare them a little bit tonight, but we're going to spend most of our time on the Mailbox Money program, which personally I think is the best bang for your buck, and I'm going to show you exactly why. Okay, let's do a quick comparison between the two programs. So I've got QFCR on the left and Mailbox Money on the right. Okay, and what you really need to focus on is here in red. Okay, this establishes the risk. In the QFCR program, we are basing our loan amount off to the after repair value at a max of 70%. Okay, in most cases, your loan amount will be at 100% or more than the acquisition price for the borrower. As opposed to Mailbox Money, we're talking about 60% of the appraised value. That means our borrower is coming in with 40% down payment or 40% equity in the case of a refinance or a cash out refinance. Okay, huge difference between the two. There's also the time frame. So the QFCR, 12 months, so ultra short term. Whereas the Mailbox Money program kind of runs the gamut of, you know, midterm 5 to 10 years, and then getting into the longer term of 15 to 30. So the takeaway points here: QFCR, higher risk, super short term, and one thing I didn't mention is it's a battle to constantly stay invested. Right? Sure, it's nice to grab that higher return, but you have to understand that an annual return is much more important from an investment standpoint. From the Mailbox Money program, the takeaway is it's much lower risk. And it's plain and simple, right? If a borrower's got 40% skin in the game, the likelihood of a default is very minimal. And then again, mid to long term, and you fund it and you forget about it. You don't have to constantly be looking to get into the next deal, right? Okay, in either program, very simply put, you, the investor, you're lending money and you're collecting interest. A little bit different than what most people think about when they talk about investing in real estate, right? Most people are buying the property, playing the landlord, and collecting rent. Now, that's good too, but you might want to think about some diversity, especially for those who really want something more passive, right? Mailbox money is just about as passive as it gets. Okay, how do you actually do this, right? Well, you fund a new loan. You, as the investor, you become the bank and you fund a new loan. It's just like the bank does. Or you can buy an existing loan, right? Just like Fannie Mae and Freddie Mac, biggest buyers of, secondary market mortgage paper, if you will. Okay, so that's specifically how you do it. And we do both, right? When we get to the website, the mortgage page, I'm going to go over with you tonight. Basically, you can fund a new loan or you can buy an existing loan from somebody who wants to sell it. So welcome to Mailbox Money. This is the ideal program for those income investors, right? That's very important. But these income investors are in search of a consistent, low risk, and as I mentioned, ultra passive investment, which protects principal and earns a great yield. Now, I used to have a poll in here all the time about return on investment in your retirement account, but I took it out because everybody's claiming 6% and under. And when it comes to Mailbox Money, we're 6% and over, right? So it just didn't make any sense to have that anymore. It's just this program offers a great yield and a great mix of principal protection. Now, it's not for everybody, okay? Let's take the example of a young couple saving a nest egg, looking to maybe in the next 2 or 3 to 5 years put a down payment on their primary residence. Now, you certainly wouldn't want to get into Mailbox Money if you had $50,000 to invest in that situation, right? Because you're going to need that money. And in the Mailbox Money program, it's longer term than that, right? But a good example would be me, for example. I have a self-directed IRA, and I can't use that retirement money for many, many years to come. So I've adopted a strategy after doing this for several years that I'm just jam-packing as many of these mid to long-term loans that spin off a monthly payment and are just a straight cash play. My retirement account's building much faster than a separate retirement account I have with a financial advisor who's meddling in the stock market. Another good example about Mailbox Money, who an ideal person for that, or an ideal couple, which if you take a look at the screen, I've got a green box. Clients of mine, recently retired, have a self-directed IRA as well. And they've got about $200K that they put into it. And these 3 loans are in process, right? These are 3 Mailbox Money loans that they've decided that they'd like to fund. And I've got on the screen the loan amounts, the appraised value, right? Of course, the loan to value, and across the board, it give you all the details. So the takeaway from this is $178 grand, they're going to keep a little bit in reserves. They're going to invest. Okay, that's the total that I've got right here. The monthly payment cumulative across those 3 loans right here. The 3-year interest guarantee, I'm going to talk about that a little bit more as we go. And then the total potential interest that's all going to spin off this principal investment, right? Fantastic opportunity here, guys. And it doesn't have to be a retirement account. Both examples that I gave are self-directed retirement, like a solo 401k, for example. But if you just have cash, take my folks, for example. That's what they do. I've got them doing this. Okay, get my highlighter off there. There we go. All right, tonight's topics. Details of the Mailbox Money program. We're also going to cover our mortgage page on our website. Mortgage page is fairly new. One thing I want to mention about it, it's launched, I think, last July, and it doesn't include all of the loans that we've done historically, right? It was just too much work to go in and put in and input each one of those. So it only includes the loans that we have done since last July. But it's a very cool web page. I hope you guys like it, and it's constantly changing, and many, many good things to come. And then lastly tonight, we're going to cover an analysis. We're going to put Justin Smith, who chose the Mailbox Money Program, face-to-face versus Mary Brown in the QFCR program. As I can tell you, I have conversations constantly with investors, and they all gravitate towards the sexy QFCR program. And really, it comes based on their desire to go after the higher return, right? But I'm going to show you tonight in an example that that's not really the case. It's more of a facade, and that you want to chase that high interest rate, the 9 to 12%. Okay, so it's not a syndication, right? I got an infographic on the screen that talks about what a syndication or like a mortgage pool is. This program is not that, okay? This program offers the ability for you, the investor, to own the mortgage, right? And we don't put multiple mortgages, multiple lenders on one mortgage. That can get messy, right? We want you to make the decision whether you want to fund that loan. And in the off chance that there is a default, well, you don't have to answer to anybody else, right? You as the lender are going to make the decision. Of course, we only do non-owner occupied loans, right? It gets a little sticky with owner occupants, and we stay out of that space. So only investors, again, no owner occupied loans in the Mailbox Money Program. Okay, who are our borrowers? Extremely important. Well, these are Marshall Reddick clients. Primarily, #1 borrower in my program are folks with self-directed retirement accounts, and they need non-recourse debt. Now, I got a lot of newbies on the call, so what do I mean by non-recourse debt? Well, I mean that you certainly have the property as the collateral, and you certainly can foreclose on that property should you have a default. However, in a non-recourse situation, you cannot go after the borrower, just the property. Okay? And this is a requirement for non-recourse loans. And the reason being is because in a non-recourse situation, the borrower is actually the IRA, and retirement monies are protected. And so if you make a loan to an IRA, you of course can take the property, but you cannot take any of the assets in the IRA, nor any of the assets of the beneficiary of the IRA. So that's non-recourse. Second and third primary people who are my borrowers are folks who are looking for a low loan amount. $50,000 is kind of the threshold of what banks and conventional lenders will make, right? There's just not enough money in it for them to lend loan amounts of under $50,000. And as we're going to see tonight, I'll show you here right on the screen, $45,000 is kind of the average loan amount for the Mailbox Money Program. I do get into loans as low as $25,000 approximately, but nothing really under that. And the reason being is that if it's lower than $25,000, it's probably not a good property, probably not a good neighborhood. But an average loan amount, $45,000, we're probably talking about what, an appraised value around $75,000. It's a pretty nice property in a lot of areas around the country. Okay, so again, second common borrower is one who needs a lower loan amount that they can't get from a bank. Third is going to be if they have more than 10 mortgage properties. Okay, so Fannie Mae and Freddie Mac set the guidelines today for the conventional lenders, and they're telling the conventional lenders, hey, if a borrower has 10 mortgaged properties, you cannot make the 11th or 12th or 13th mortgage to them because we will not buy that mortgage from you in the secondary market. Okay, so these are all sophisticated borrowers that are going to be taking these loans, right? Solid borrowers with solid down payments. So let's talk a little bit about my available loan programs. So this graph on the screen here, this is actually geared towards my borrower. However, it's important for you as the lender to understand what programs are available. Okay, so I would call this my rate sheet with all my details on it. And I want to point out a couple of things. So I've got 4 loan programs, 3 of them with 30-year amortizations, 1 15. The balloon payment means they got to pay off at year 5, and they got to pay off at year 10. These are fully fixed and amortized 15 and 30-year loans. I also want to point out that 60% max loan to value, right? We talked about that. I also want to point out the 3-year interest guarantee and this operating income. We must see massive cash flow on the borrower side, making it even more safe in order for us to make these loans. Okay, so just so you guys understand the different loan programs that are available. Now, you don't get to choose these, the borrower does, remember that. But you can tell me, of course, hey, Pat, I'm not interested in doing anything more than 15 years. Totally get it. I might disagree with that, because I think the 30-year fixed loan is the best, right? And I know what you're thinking there. You're thinking, Pat, you're asking me to lend my money for 30 years, and I'm saying absolutely. And the reason I'm saying that is because, as we all know, no borrower keeps their 30-year fixed mortgage for 30 years. Statistics show that they keep it for, 5 to 7, right, before they refinance the loan and pay off the lender, or sell the property and pay off the lender, or another scenario like that. So again, I think, particularly for me, this 30-year fixed, 8.5%, when you can find those, man, that is a slam dunk. Put that in your retirement account. You'll thank me later. Okay, so like I said, this is a niche market. The banks aren't doing non-recourse loans. They're not doing loans under $50,000, and they're not lending to folks building big rental property portfolios. Okay, and again, solid borrowers, down payments, right? This is good stuff here. Okay, so let's get into some important details about Mailbox Money. Okay, knowledge, experience, and integrity of the broker. We're going to talk about that. We're going to talk about collateral property, loan documents, big one, escrow, got to have it, insurance, property taxes, and loan servicing, most important. Okay, so as far as the experience and integrity goes, I mean, Marshall Reddick, as you guys know, maybe some new lenders here, but I see a lot of familiar names on the call. We've been in business since 1979. Multiple ups and downs, and it just goes to show the longevity of the type of firm that we are. And of course, myself, I'm kind of the senior member on the team, started in 2003. Right, so, geez, I can't believe it. Almost 14 years. It's been an incredible ride, and I've learned a ton. I wouldn't change it for the world. So let's talk about the collateral property and the appraisal. Very important, right? You're going to be making a loan against a property, right? Most of the properties in the Mailbox Money program are going to be turnkey. They're not going to be distressed like they would be in the QFCR program, right? They don't need renovation, okay? As far as an appraisal goes, every property gets appraised, right? We use Valuation Management Group out of Georgia. That's a third-party appraisal management company. So it's an arm's length transaction, if you will, right? I don't know the appraiser. They don't know me. I call my appraisal management company. I schedule my appraisal online. They go out there, appraise it. I get a copy of it. I share it with you as the lender, right? Maximum loan to value, 60%, right? Simple. Loan docs. Okay, well, Fannie Mae and Freddie Mac, they have standards, right? You can find these on these websites here. And we have adopted and use those standard Fannie Mae and Freddie Mac docs, okay? They're prepared in-house right here in Newport Beach. And you get to review and approve them before you fund any loan. We're very transparent in everything that we do here, and you get to see pretty much everything. When we get to our website, you're going to just be overloaded with information. But in terms of, the details of the loan, you get to see it all. You get to approve it all. You are the decision maker. Okay, so escrow. Got to have escrow on every transaction. Okay, if you ever get into a situation, trust deed investment, mortgage, private lending, whatever you want to call it, and you've got a borrower saying, hey, I'll sign the note, just wire me the money directly. Just turn and run the other way. That's not how it works. You've got to use escrow. We require it in each transaction, and for those who are unsure, escrow is an unrelated third party. Right? They work independently of the seller and the buyer in the transaction and on behalf of the lender, right? So wanted to mention, a lot of people think, I don't wire the money into escrow to fund the loan until I've seen the executed loan documents. And that's just simply not true, right? You can wire your money into escrow 2 or 3 days before the transaction is going to close. If for some reason it falls apart or escrow doesn't get those executed loan documents, right, they're just going to turn around and wire your money back. It's not like you wired your money and you're never going to see it again. Right? And a lot of people who've never done this before, they're a little scared. I can understand that, right? But that's why we use escrow. Okay, insurance, hugely important, right? We require it on every property. Now, why is this important? Plain and simple. Right, you make a loan to a borrower and the property is uninsured, let's say, and gosh forbid there's the tenant that's in the property has a grease fire and the property burns to the ground. That's pretty catastrophic, but at the end of the day, if that happens, borrower still owes you the money, but if there was no insurance to pay out on a claim there, it'd be a lot harder to repay that money to the lender. So we require it, and we also provide you with a copy of the evidence of insurance prior to funding. Similar like I was talking about with the loan docs. So this is what your evidence of insurance looks like. This is like an Accord form. It's standard in the industry, right? Every insurance company can provide this to you. And highlight a couple of things. So Joe borrower, so you're going to see the borrower's information is always going to be there, who the insurance agent is, who the actual insurance company is, right? The term or the policy effective dates, right? The property address, the coverages, and of course, the lender. Very important, right? Your name's got to be listed here as the mortgagee. Now, that's super important, right? Because if for some reason the borrower doesn't make payment on their insurance policy or tries to cancel it or tries to do anything funny, right, the insurance company has to mail out a letter, right? And they mail that to the insured, who in this case is Joe borrower, but they're also going to mail it to the lender, who would be listed here. So when you make a loan with me in the Mailbox Money Program, I'm going to add you to the insurance policy of the borrower, and I'm going to show you a copy of it before we fund the loan. That way, you know insurance is in place and you feel good about it. Okay, property taxes, another big one. Okay, right? Property taxes need to be paid. We enter into a loan transaction, we require that the borrower bring the property taxes current, right? Usually they are, but you never know. If it's a refinance transaction, we need to make sure that those property taxes are current. So they will be brought current in every transaction with us at closing. And then for future reference, you can certainly pay your loan servicer to track the property taxes for you, but it's not that big of a deal, right? I don't do it for all the loans that I fund. Right? I can go to the county website myself once a year and see that the property taxes are getting paid. And at the end of the day, most jurisdictions, it's 5 or more years before the taxing authority is going to get in your face and try to lien the property, right? And of course, if that happens, then you're in trouble because the property tax lien could take priority over a lender's lien. But again, you've got plenty of time, and if you're worried about it, pay your loan servicer to do it. It's very inexpensive. That's my segue to bring us into loan servicing. Absolutely have to have it, okay? Some people in my Mailbox Money Program want to tell me, I can just service it on my own. And if somebody tells me that, I know that they've never done a private loan before, all right? So we require it on each loan. It protects the borrower and the lender. So I personally use Superior Loan Servicing, and I recommend them to all my clients. They're a firm right here in California, out of Calabasas, actually. You can check their website. I also have used Note Servicing Center, also in California. They're up in Chowchilla. but nonetheless, both good companies, very similar structures, very similar fees. Consider them a property manager for your loan, right? Bottom line being, those of us in real estate probably own rental property, and you understand the concept of not managing your own property. Why would you want to manage your own loan? So a couple of the items that the loan servicer is going to be responsible for: monthly statements. They're going to mail one to the borrower, right? They're going to collect the payment and distribute it to you, right? You don't want to worry about collecting the payment from the borrower, right? So you can set up a nice online account with the servicer. You can change your banking info. They'll automatically deposit the proceeds of the monthly payment. It makes it very simple. They also handle the year-end paperwork, 1098, 1099, and a biggie for me is the loan payoff, right? If you're servicing your own loan, and let's say fast forward 5 or 6 years later, you've been collecting monthly payments as well as sporadic additional principal payments that would change the amortization table, right? And then all of a sudden you get a call from Escrow, and it's like, hey, Joe borrower at 123 Main Street needs a payoff on his loan. You're listed as the lender. And you're going to say, uh-oh, and how long might it take you to go through the accounting to come up with a correct loan payoff? So do yourself a favor and stick with us and hire a loan servicer. So Superior Loan Servicing, they do have a bunch of additional type services that you can sign up for, but I don't think a lot of them are necessary. These are the basic servicing fees they offer. So it's a one-time setup fee. Call it boarding. Board your loan, $30. Monthly servicing fee, $20. Right? So every month the borrower makes a payment. Superior Loan Servicing is going to withhold $20 from that payment and remit the balance to you. And like I was talking about property taxes, if you want Superior or any loan servicer to be in charge of making sure the borrower makes their property tax payments, pay them a little extra fee to do it. So in this situation, $25 per month and a one-time setup fee of $30. It's peanuts for the peace of mind. Okay. Now they do have other services. For example, I get asked a lot about actually like an impound account where borrower pays a little bit more monthly towards their property taxes and insurance. They certainly do offer that, and if that's something you really want, we can definitely set that up. It's just more expensive. It's an additional $45 one-time setup fee and an additional $20 per month. And at the low loan amounts we're doing, that can drastically cut into your return. So I don't recommend it. I don't think it's necessary. All right, let's jump into some risks, and also important to debunk some myths. I get a lot of myths, right? So default, absolutely number one risk there is, okay? We are lending money to a borrower. It's very secure considering the large down payment and equity position the borrower wants to protect, right? They've got a high cash flow property. They're going to do everything within their power, recession or not, to make that monthly payment, right? However, at the end of the day, if we do get a default, you need to be okay taking the collateral property, right? We do that in foreclosure. So what's the worst case scenario? You own the property. At that point, you could rent it out, collect rent if you want, fix it up if it needs a little fix up. You could just sell it. It's your property after you take it in foreclosure, and you can do whatever you want with it, right? But it's not like the stock market where if it hits the skids, right, a lot of people investing in penny stocks and whatnot, they can go to zero, right? There's no collateral in that situation. So I think it's a lot safer than the equity market. Okay, rising interest rates. This is a fairly new one that I've been getting, right? And I think it's because we just had an uptick in the interest rate. But, you know, my rates, as we talked about in the Mailbox Money program, 6.5% to 8.5%. So that's a fantastic return over the long haul. And I'm not going to be upset about collecting a monthly payment at, you know, 7, 7.5%, 8.5%, regardless of interest rates. Now, you know, certainly it does have an effect, you know, if you want to sell your mortgage paper at some point in time, just like if you wanted to sell your property. Interest rates, if they had gone up, let's say to 10%, can't imagine that happening, but if that happened during the term of your loan, that would have an effect on the value at which you'd be able to sell your mortgage paper. Okay? Nonetheless, it is a risk. I'm not too concerned with it. Natural disaster, I throw that one in kind of as a joke, but some people are worried about it. You know, tornado comes and blows the house down, or the fire, or, you know, whatever we talked about. That's why you have insurance. So don't spend too much time, or don't be worried about a natural disaster. You're covered. Investment length. This is a big one. Pat, you're asking me to lend my money for 30 years? We already talked about that. Okay, so I don't particularly think that my mailbox money programs, again, 5, 10, 15, or 30 years, are particularly long-term, right? Those of us who are rental property owners, do you ever go into a rental property investment purchase thinking that, you know, in 2 or 3 years you're going to sell? No. And if you do, those are the people that get burned, right? Those were the speculators in 2005 and 6 that were seeing 20, 30% annual appreciation, who were buying those rental properties and think they're going to cash out. We've all learned that mistake, right? Rental property is a long-term investment. Mailbox money is a mid to long-term investment. Okay, so don't let yourself be fooled by thinking that you're getting into something that's going to lock up your money forever. Right? And frankly, if that happens and you did get one of those 30-year fixed borrowers who kept it, those 1 or 2%ers, right? You just made out like a bandit with all the interest that you earned. Liquidity. Okay, this is also important, right? Some people are like, hey, I make this loan, I got this mailbox money deal going on, but at the end of the day, what happens if I need to get out? You know, if I got an emergency or something? No problem. Right? There is a very liquid secondary market for mortgage paper, especially at interest rates like we are lending. Okay? I just helped a client recently who had 3 or 4 years ago originated a loan with me. Right? He'd been collecting the payments for 36 months or so, and he said, look, I'm looking to go a different direction. Can you help me sell this loan? Right? I loaded it into my website. A couple days later, I had people clicking, I'll fund that loan. Right? So that'd be a performing loan that you buy in the secondary market. Right? We talked about that a little bit earlier, where you can either fund a loan or you can buy an existing loan. So we're going to do both of those. Some people as a lender prefer that, right? They'd like to see, hey, I've got a 36-month track record. Borrowers made their payment on time. Now they feel good about it, so they'd like to buy that loan and take over as the lender. We offer that investment as well. Okay, so that handles our risks and our myths. Okay, let's talk a little frequently asked questions. Get these all the time. As a lender, what costs and fees should I expect? Well, as a lender, first and foremost, there is no fee to Marshall Reddick to participate, right? The only costs you as a lender are going to look at are going to be the wire transfer fee. Your bank's going to charge you that when you wire your money into escrow. And then, of course, your loan servicing fee. Other than that, no fees. That segues into frequently asked question number 2. How does Marshall Reddick make money? Right? Well, we're just like any loan officer, right? You as the borrower, if you bought a rental property with leverage, or you purchased a primary residence with leverage, you work with a loan officer. That's me on this side, right? And you pay your loan officer a loan fee, okay? And that is paid at the close of escrow. And again, that's paid by the borrower. Okay, so that's how Marshall Reddick makes money. Another common question, do I need an entity like an LLC to invest? Well, certainly if you'd like to invest with an LLC or you already have one, no problem. But don't think you need to run out and create one just to participate. Any type of entity is fine, corp, trust, LLC, you name it, we do it, right? But the fact of the matter is that I'm not an entity guy. It's very expensive to create and to maintain, and I need to simplify my life as it is, right? So I just make the loans in my personal name. Unless it's in my self-directed IRA, of course, then it's in the name of my IRA LLC. Okay, how's the interest taxed, right? I'm not a CPA, you guys. I can't really answer that question for you. but I can tell you that it's interest income, right? It's going to go on your 1040. You are going to pay tax, however that plays out into your personal situation. And as much as I dislike paying Uncle Sam more money than I absolutely have to, because I pay my fair share, right? If you're paying tax, you're making money. That's how I look at it. That's what makes me feel good. Tax benefits. Unfortunately, there's not, right? It's not like owning a rental property where you get to write off your interest expense, or you get to write off the depreciation, property taxes, insurance, all that kind of stuff. It's a straight cash play. You're earning straight income. Now, in some cases, you may be able to write off your wire transfer fee or your loan servicing fees, right? But you need to check with your CPA for all those types of specific questions. Okay, do I check the borrower's credit? Excellent question. And the answer to that simply is no, right? All of our loans, whether Mailbox Money or QFCR, are straight asset-based loans, okay? That doesn't mean that we're chasing subprime. I showed you the 3 primary examples of who my borrowers are. But the fact of the matter is that we do not represent the creditworthiness of the borrower. I'm okay with that, right? The interest rate is higher. The risk is low. Again, 40% down, 40% equity position, right? So understand that that's the case. If they could get a bank loan, right, for whatever the 3 scenarios were, they would, and we encourage that. Those of you at Marshall Reddick who know us, we advocate conventional lending when at all possible. However, there's a lot of people who need to go private, and it doesn't have anything to do with having bad credit. Last question, or at least of the frequently asked, if I experience a default, God forbid, can I call Marshall Reddick for help? Absolutely. Now, I don't have any defaults in my Mailbox Money program. I don't have any, not one, right? My default rate in my QFCR program is very low too, but I have had defaults in that program, right? But it's a lot higher risk. But at the end of the day, you know, obviously in the Mailbox Money program, you're going to have your loan servicer who will help you with that as well. But no matter what, you can always call Marshall Reddick. That's what we're here for. So let's just chat real quick. Let's talk amortization table. All right. This is super cool. And a lot of people have never actually really looked at this, right? If you've gotten a loan before, rental property or primary residence, it's in that huge stack of loan documents that you have. But if you haven't looked at it, I'm going to show you one. So here we are. The one I'm going to show you is a 30-year amortized loan, 10-year balloon, 7.5% interest. So hopefully it's big enough on the screen for you guys to see, but I want to run through it real quick. So we're hypothetically talking about a purchase price or value on this property at $80,000. That's there at the top. 60% loan would be $48,000, which I've got listed here. Okay, that spins off at 7%, a monthly payment of $335.62. Now check out this, right? The payments are always the same, but look at this interest column, right? Out of the $335.62, it's almost 100% interest. Man, the finance majors who came up with this are geniuses, at least from the lender's perspective. But this is standard practice. This isn't something that I created. This has been in play forever. This is how this is how all loans work, right? So very, very little principal. Okay. Now we talked about an interest guarantee. So I want to spend some time on that. You see that right here. And so in this particular loan, the interest guarantee is $10,650 roughly. And all that is the cumulative interest here in this column I'm showing you, paid over the first 36 months of the loan. Now, call that a prepayment penalty if you want, but at the end of the day, what we're saying is the borrower cannot effectively pay off the loan, and you as the lender will not effectively release your lien on the property unless you receive that dollar amount, that $10,000. So borrower can certainly pay off the loan here at month 19, let's say, but at month 19, you've only earned $5,600 approximately in interest. right? If they want to pay it off then they've got to pay you the difference between this 56 and this 10,000 in one lump sum in order for you to walk away. Right? Now, we do that for folks because we don't want them using our Mailbox Money program to flip property. Too much work in this for you to enter into this transaction and not make a good amount of interest. So that's why we've instituted that 3-year interest guarantee. Okay? Balloon payment, that's important, right? Check this out. This, again, is the 30-year AM, 10-year balloon. So that means that the borrower is going to make these 335.62 payments every month. And after 120 payments, that's 10 years of making that payment, they still owe almost $42,000 on their original $48,000 loan. That's crazy. Again, sorry to be so animated, but I love this. This is real deal investing, and we're bringing it to you through Marshall Reddick and our Mailbox Money program. Okay. Now we've got that out of the way. Let's get those off the screen, and let's talk about the mortgage page at marshallreddick.com. So bear with me. I'm going to pull it up on our screen so that we can go over it. Okay. Here's the home page. Everybody can see that? Give me a couple of chat in the box there if you could. Let me know. I think you guys can see it, so we're going to go with it. All right. Mortgage page, this is our home page, right? And the mortgage page can be found right here under the properties. So you go ahead and click on the mortgage page. And here it jumps me into the list view. I can see several mortgages, and they say available, and there's some information on the screen. So this is the list view. Now, outside of that, I want to point out these filters here. These are very, very important, this top row. Okay, so I'm going to get my highlighter out again. So here are my filters. Okay, so I'm going to go ahead and click on More Filters so that you guys can see this drop-down box. Right, so I've got buy and hold selected. Maybe you don't want to look at buy and hold. Maybe you want to look at fix and flip. Again, buy and hold would be Mailbox Money, fix and flip, QFCR. Okay, so I've got buy and hold selected, and I can see available. I can see deals funding in process. Now, what does that mean? Funding in process means I've already taken a commitment from a lender just like you, and I'm in the escrow process. I can look at deals that are previously funded, right? You name it, you can search by all these different criteria. So I'm going to say that I only want to look at available deals, buy and hold, and then I'm going to go over here and click Done. When I do that, now I get back to my list view, and I can see all these different mortgages that are available for investment. I've got the investment amount. Investment amount is going to be here. The yield to maturity, the lien position, right? 99.9% of the loans we do are going to be first lien position. The term of the loan, right? So this 120 months, that means it's a 10-year balloon loan. This one here that says 180, that would be our 15-year fixed loan, right? Maturity, that's to be determined, right? Because it's an origination loan. We haven't originated. This is a new loan that's being made. Now let's fast forward down here and get those cleared. Let's fast forward down here. I do have one on the website right now that is performing. Okay, so that would be a loan that's already been originated, that the current lender is collecting monthly payments on, and it's available for sale. Okay, so that would be a little bit different, but just to understand the difference between origination and performing. All right, so let's erase and get back on it. So let's dive into one of these. Okay, so let's talk about, let's take this one here in Jacksonville on short read. Okay, so list view, hit full details. That takes me into the detail view. Right now, I've got tons of information here, but first and foremost, I want to show you guys is the cool stuff. right? I see that this is a buy and hold, right? This actually is a refinance. So this borrower is refinancing the current loan that he has, right? Here's the specifics. I'm looking for a loan amount of $38,000. It's an 8.5% yield. Well, you know that that means it's a 30-year fixed. This is one of those good ones I was talking about, right? You are in first lien position. Your monthly payment is $292. Your interest guarantee over 3 years is $95, $78, $51. And your total potential interest on this, that would be after the full 30 years, after investing $38,000 and collecting payments, you would have collected $67,000 in interest. Amazing. Okay, let's clear that up. Okay, so all of these fields offer good information, right? Loan term, you get this repayment timeline, you get to see the loan value, right? You get to see all the third party. You want to know who the escrow company is, the loan servicer, the insurance company, right? You want to see photos of the property. Let's take a look. Scroll through them, right? It tells you when it was built, beds, baths, square footage, market rent, loan amount, current market value. Again, you're going to get the appraisal as well, right? What are the property taxes? What are the insurance? Hey, let's see some rent comparables to make sure that the market rent is actually what we said it was, okay? You have all the information at your fingertips. This is super cool, and it's changing all the time. The other cool things I wanted to point out to you guys very, very quickly, we're going to be driving everybody to this button right here, okay? So you'll have to click fund this loan. Right now it's happening through email or telephone call. I'm taking commitments on loans, but pretty soon you're going to have to drive everyone through fund this loan. When that happens, you're going to have a disclosure that you're going to sign, and I'm going to get an email that says you're ready to go. I'm going to give you a call, and we are going to take it from there, jump right into escrow. So again, that's a little bit about the mortgage page on the website. I hope you guys enjoyed that. Spend some time, you know. As I mentioned, there's also here, I didn't mention, there's some tool tips, right? If you have questions about it, you can hover over it and you can see we call those tool tips, right? So spend some time, guys. Again, invest, mortgages. That gets you to the list view, and then you can dive into any of the details. You can also check your filters and look at anything that you want to look at. Okay, so let's get the PowerPoint back up and let's continue on. Wrap this up. Let's look at an analysis. Very, very cool here, right? We talked about this in the beginning, how a lot of folks are going to gravitate towards the higher interest regardless of the risk, or usually when they say regardless of the risk, it's because they don't understand the risk and all they see is 9, 10, 12%, and they want to chase that return. So very simple analysis that I'm going to give you, and we're going to have a little fun with it. So Justin Smith, he chose Mailbox Money, and Mary Brown, I couldn't convince her otherwise. She's going short term in the QFCR. Okay, they both have $100,000 to invest. Well, before we move on, let's take another quick poll. Okay, as a private lender, what is more important, your interest rate or your annual return? So I'm going to launch that poll now. You should see it on your screen, and I love your vote. Man, I don't have anybody clicking interest rate yet. Oh, there's a couple. Appreciate you guys voting. We're going to let this go for a couple more seconds here. See if we can get to 80%. Okay, so we are going to close the poll, right? And I'm going to share that with you. Hopefully you can see that on the screen, but in any case, 23% of you, about the same amount who had done private loan before, think that the interest rate's the most important thing as the private lender. But the overwhelming majority, congratulations to you, that is the answer that I would select. But it's those folks that think the interest rate is higher that are going to gravitate towards the QFCR program, right? So let's go ahead and hide that poll and move on. So here's the details, right? Remember this slide? We talked about this in the very beginning. So the points to take away here, I'm going to talk about it. Fund it and forget it in the Mailbox Money, and a battle to stay invested in QFCR. What do I mean? All right. So Justin Smith, going Mailbox Money, he had to do 2 loans, right? Remember, my average loan amount's about $45,000, so these are right in the ballpark. Justin did a $40,000 30-year fixed loan, and he did a 10-year balloon at 7.5 with $60,000. Okay, both of those spinning off a monthly payment for him. He just had to fund it and forget it. And this is how it looks over 3 years. I know a lot of information on the screen here, but I'm going to point out a couple things. Okay, so these here, these 1, 2, 3, 4, 5, 6, these are months, right? And then this, I can only get 18 on the screen, then I've got 19 through 36 down here, right? And here's the first loan, and here's the second loan for the first 18 months, the total monthly payment he's getting. And then loan 1 and 2, same loans again, just in the latter half of the 3-year period that we're examining. Okay. Now, let me remind you here that these are net interest earned. So I've already backed out your servicing costs and your wire transfer fee to enter into this. These are net interest figures, not principal, net interest. Okay. So you can see what he's just collecting every single month, right? So over 3 years, Justin, in the Mailbox Money program, investing $100,000, earned $21,000, almost $22,000 net interest, right? Simple math, that figure, 22 almost, divided by his 100,000, divided by 3 years, gives me my average annual return right here at 7.28%. A fantastic return, okay? The guys on Wall Street don't earn that on average. All right, so let's clear our screen and move on. Now, let's talk about Mary Brown and QFCR. Okay, so she said, no way, interest rate's more important. I want to go with the higher. I'm okay with the risk, whatever her scenario was. Okay, so she had to do 7 loans, but I didn't want to overwhelm you all at once. Okay, and she can't do them. She can do them at the same time, I guess. But remember, she's only got $100,000 to invest. So her first loan, she was only able to get in for $90,000 at 180 days was the length of the loan, and then she had to wait 15 days to get into the next one, right? And what I mean by that is, you know, when your loan pays off, now you got to go back to the website. Now you got to find an available loan that suits your criteria. Now you got to wire your money back in again. I'm not saying it's a bad program. QFCR is great, and I have a lot of folks doing it and a lot of folks making a lot of money. It's just a lot more work, and you got to be on your horse to constantly stay invested. Okay, so loan 2, right? 12% this time. Awesome, right? $75,000. So remember now, he's got $25,000 sitting on the sideline because he doesn't have another loan. He wants to stay. She wants to stay in QFCR, and I don't have a loan of $25,000 available, right? Or at least one that's suitable for marriage, and so on and so forth, right? Then loan 3 comes up in $60,000. Okay, now Mary was able to actually fit 2 in. See, loan 3 and loan 4 were 60 and 35, so now there's 95,000 of her 100,000 invested, right? And these are all paying off at different times, and she has different time frames in between when she can get on there. So I'm going to show you, though, all the 7 loans that it took her to get through the 3 years and collecting those balloon payments as they matured. I also wanted to point out, however, the more loans you do, the more likely you are to have a default. Again, very, very low default rate in both of my programs, or non-existent in Mailbox Money. But at the end of the day, the law of numbers, the more loans you do, the more chances there are. Okay, so let's graph this out actually. So hopefully you guys can get this. But here are those same loans that Mary Brown funded in my QFCR program, right? I've got the loans numbers down the side over here, right? And I've got, again, the months, 36 here on the bottom. The green represents the length of time that each of those loans was out. And you can see I've got it written here, 180 days, 145 days, 110. The red represents the time off. That means earning no interest, right? So as you can see, it doesn't take that long for your whoop-de-doo magical 10, 12, 10, 12, 10, all these high interest rates, right? Over the 3 years, including the time off in between, she earned 22.7 on her $100,000 investment. Again, net. This is taking out all the wire transfer fees that you had to do and you know, whatnot. So keep that in mind, right? So her average annual return, 22,743 divided by 100 divided by 3 years, boom, 7.58%. Pretty much the same, with a lot more work and a lot more risk. Again, I don't want to discourage you from doing QFCR. We're talking mailbox money tonight, but really, again, as I mentioned earlier, that's where the best bang for your buck is. Okay, here's the summary between the two, and we're going to wrap this up. I know it's getting late. I want to let you guys get going. So Justin Smith and Mailbox Money, 2 loans, total net interest, 21.8, low risk. Annual return, 7.28. Again, this is over the 3-year period that we're examining. Mary Brown and QFCR had to do 7 loans over the 3 years. Total net interest, 22.7. High risk in the QFCR program. Her annual return, 7.58. Now, I hope you guys can see that simple analysis about how the average annual return is much more important than the interest rate. I also want to add one point here, right? Again, these are simple numbers, but in the mailbox money, don't forget that I'm collecting every month a principal and interest payment, albeit that principal portion of the payment's very low. However, you can reinvest that principal every month. That's a strategy that I personally have adopted, again, using my self-directed retirement account. I stick all that principal that I collect back monthly directly back into a very conservative Vanguard mutual fund, right? So now my internal rate of return, which is a lot more difficult to calculate, and I didn't want to overwhelm you guys, goes up. So at the end of the day, this simple return here, even though it's just a tiny bit lower, my internal rate of return is going to be higher if I do something like I just mentioned, like dollar cost average my principal back into an extremely safe Vanguard mutual fund. Yep. Get that off. All right. I've said my piece. I hope you guys enjoyed the presentation tonight. I'll be following up with each one of you. We'll also have the PowerPoint slides that I've gone through tonight available. If you'd like them, send me an email, and we'll be following up with you. Want to get your feedback, want to understand your thoughts, and I'm looking forward to working with you. Every time I do one of these mailbox money programs, I pick up, I don't know, half a dozen new lenders, and I hope you are one of those, and I hope to work with you. So again, appreciate y'all being here tonight. I hope you enjoyed the presentation. Good night.